Thanks for watching. Today I'm working more on my stock market tool. I'm working on the portfolio level strategy. So before I get into what I'm doing today, let me go over the broad overview for the project, what I'm working on, what I've been doing recently, and finally what I'll get to today. Then I'll get down to business. So here's the overall outline for the model. So I have two goals. My first goal is to beat the S&P 500 by a significant margin while staying market neutral. So the S&P goes up on average 6% per year. I want to do significantly better than that, 3 to 4 times better than that, and get 18 to 24% per year. With the caveat that I want to be market neutral. So the strategy should be immune to whether the market's going up or down. It should be go long on several stocks, go short on several stocks, and capture the spread between them. So this at the bottom is the outline for the model. I have data going back to 2011. So, but you don't want to use all data to train a model. So different things move differently. ETFs, for instance, are going to move different from things like Apple or Tesla. And so I've isolated several, there's also all sorts of financial instruments, but I've isolated three different asset classes that I want. So ADRs, which are foreign companies listed on the US stock market, common stock, things like Apple or Tesla, and real estate investment trusts. And so those are the three things I'm looking at. I'm only looking at the top by dollar volume. I'm trimming out everything that has low price under $5 to eliminate penny stocks. I'm trimming out all ETFs. And I'm trimming out everything that's dropped over 50% in the last calendar year. And then the universe updates every month. So once I had this universe, the next step was to train a returns model. This should be predicting something like returns relative to the market, relative to sector, probability of a positive return, something like that. I found really good success training for the 5-day forward Sharpe ratio. So what's the Sharpe ratio going to be over the next 5 days? So I have a good returns model, and now I'm working on this final stage, which is implement a portfolio strategy. It should be fairly simple, and it should just take the output of the returns model and make buys and sells accordingly. So I'm writing all of this code in Python. So I also have a secondary goal. Hey, good morning, Soul Water, or afternoon where you are in India. How are you doing? Is your week off to a good start? So yeah, the once I have a good returns model, the final step is implement some simple portfolio strategy, which allocates buys and sells based on the output of the returns model. Now I have a good returns model that I arrived at about a month ago. And since then, I've done a little bit of tweaking to it, but this is the core model. So this is a single model trained from 2011 through 2019. Tests or validated. The hyperparameters are tuned from 2019 through 2022, and then it's tested from mid 2023 through the beginning of this year. So first reason I think it's good. If you look at these metrics highlighted in the red box, the top metric, information coefficient. You took a leave today. You mean you had the day off? No work today? So did you have fun? Top one's information coefficient. That's predictive power of the model. How good is the model at predicting? So my goal is 0.01 to 0.02 because the stock market has a notoriously low signal to noise ratio. I'm getting here 0.047, so comfortably well above my thresholds for the metrics. Now these next four metrics aren't giving me predictive power, they're giving me the stability of the model. So ideally you would have something that's really powerful but also really stable. And there's kind of a trade-off between the two. You can eke out more power of the model if you sacrifice stability. You could also eke out more stability if you sacrifice the predictive power. But these next four metrics are telling me the predictive power, and I'm at the threshold for the standard deviation of the information coefficient. Information coefficient to information ratio is larger than my goal by about an order of magnitude, both on a daily and annual basis. and my T statistic is about double the metric I'm looking for. So um, it's hitting or beating all of the metrics that I'm going for, so I can conclude that it's sufficiently powerful and stable. Also, if I look at the decile analysis, this is basically the hallmark of a perfect decile analysis. The bottom decile should give the worst returns, and the top decile should give the best returns, and it should be monotonically increasing between. So each decile should be higher than the previous decile. That's exactly what we see here. Finally, I did a walk forward analysis where I trained a new model for every year from 2016 through 2025. And you see here that the information coefficient never drops below my goal of 0.01. And information coefficient to information ratio never really gets close to my goal of 0.3 on an annual basis. So that looks really good. So you're at 2 players for your chess league, Soulwater. But you have enough captains, right? How many teams do you want to have? Um, yeah, so this is the model. This is where I was at about a month ago. I was very confident in it for these reasons. However, when I tried to implement a portfolio strategy on the model, when I did it on my single model, which is testing from mid 23 through the beginning of this year, it was really easy. Almost any parameters I put into the model gave a really high return, really good Sharpe ratio. You see it almost never dropped below 0. It did just for a second here. The drawdown never was greater than 10%. All of this looks great. However, when I expanded the same strategy and applied it to the walk forward model, you see it went underwater from 2016 through the end of 2021 and only went really high after mid 2023, about the same starting point as the earlier model. So now I did try, okay, what if I optimize this model for early times? And so here I optimized it from 2016 through mid 2018. You see it had really good performance in that region, but afterwards it fell off. So the problem with this model in implementing a portfolio strategy can be summed up as: if I did well at later times, I did poorly at early times. If I did well on early times, I did poorly on later times. So there's kind of this mismatch. And there's 2 reasons this could be. Number one, if you look at this dispersion chart, the dispersion in my universe, which is a proxy for the market, it increased significantly in 2020 and never went back down. So in terms of dispersion, we entered a different regime. This is because there were the rate of new stocks being listed skyrocketed in 2020, and also there were a bunch of retail traders flooding the market with stimulus checks. So for these 2 reasons, the market dispersion increased significantly. Now, what also happened right around this turnaround time is interest rates became non-negligible. So famously, interest rates were about 0% during all of the 2010s into the early 2020s, and in 2022 they got jacked up again, and they've been non-negligible ever since. So there are these 2 regime changes, basically, and I think one or both of them is driving the problem here, that it basically does poorly before 2022 and well after, or well before 2022 and poorly after. Also, if I look at the decile analyses for each of the walk forward models, you see that they're not all perfectly monotonically increasing, and the spread is changing a lot between these models. So I did find, so I tweaked around the model a bit. So I decided from this, okay, I need a better model. So I trained this model here. And basically this is the same model that I had previously, but I went through all of the walk forwards and I dropped out everything that had an average coefficient of variation above 1 and an average mean importance below 0.05. And so if I dropped out all of those features from the model and kept only the things that were important, the decile analyses actually do look slightly better. The spread's about the same, but they look a little bit more monotonic. And when I run the model with this, I found something that looks good, which is that it actually does pretty well from 2016 through 2020. It's up and down, but it's steadily gaining. And then it fails during 2020. And then kind of the failure stops at the beginning of 2021. So this is a whole new problem. Instead of having the regime problem where it either does well on later times and poorly on early times, or it does well on early times and poorly on later times. Now it's doing well on all times, but failing during the COVID recovery. Um, and it's interesting that it's the COVID recovery because it runs up at the beginning of COVID. But all of the models, all of the portfolio strategies that I'm running now are peaking sometime around March to May of 2020 is the peak. And then they fall down to the minimum around the beginning of 2021. So it's typically a 9 month downturn. Um, so I did try. Um, I found that 3 validation years does perform better. So if I sacrifice some of the training to be validation, that's improving the performance of the model. So I chose to do that. And then I tried a new thing. So the same model that I had previously that was working really well, but I added in sector neutral mean reversion and volatility features, which is something that I had found improves the model when I'm predicting returns. You see here at top, it also looks better. The decile analysis and these metrics here look better for this model. So this is my current best model. I tried improving it by doing the same thing, dropping out everything that has a coefficient of variation above 1 or a mean importance below 0.05. And that actually made the model worse, which you see here at the bottom. And so what I was looking at yesterday was you see I have this good strategy. So basically, if I take all of the scalars off and then I just scale down based on volatility, I give myself a target volatility. And then when the portfolio is exceeding the target volatility over the look back, I think I'm using 20 days. So when volatility is above the target for the previous month, scale down exposure to bring down volatility until it drops back to that level. Once it's below the threshold, exposure goes back up. So this is using only a volatility scalar. And you see this performance looks really good. So it did well from 2016 through kind of about May 2020. It was at about 100% returns, and then it fell down to maybe 60% returns. And then it went up afterwards. So this looks like a pretty good model, but it's also a simple method of scaling down exposure based on volatility. And ideally, it would be more robust if I could just use the model parameters. So I can scale down based on the spread from the decile analysis, and I could also scale down from the information coefficient of the model. So here I tried lots of different strategies scaling down the information coefficient. This is what I was doing yesterday. And so I tried to look at, what are the patterns here? Is there any uniform pattern that's improving the results? And you see, not really. I was able to achieve the green dot is the baseline performance. So I was able to bring the drawdown duration down to the baseline, but I wasn't able to really improve on it. The Sharpe ratio, there's one with a higher Sharpe ratio. That's this first data point here. The drawdown percentage is about the same. So this is basically slightly better strategy, but nothing was really clearly better here. So there were no real conclusions to draw. I have a request. Can you ask some of your friends also to play in the league if possible? I don't have many friends who play chess. Hey, me neither. I don't think I'll ask my brother. He likes chess. Um, so I wasn't able to really obtain any conclusions here. I did do an optimization here, but I didn't get anything good. So now let's see if I use only IC scaling, can I improve the strategy? So what if the only things I allow to vary are IC scaling and spread scaling? So, portfolio. So we remove volatility scaling. All right, so in optimize, now we have the objective. Number of positions, rebalance days. So let's see, should I try optimizing the whole thing? The optimization strategy. Hey man, I can play chess, add me as a friend. There you go, there's someone for your chess league. So let's see, what do we want to optimize? So, I think I want to change this code so I can specify what I want to optimize. Number of positions, rebalance days, holding period, HRP look back, buffer multiplier, smooth predictions, sizing method. So let's try doing an optimization. Not that thing. So maybe I'll try the same thing as before. Okay, so let's say we're going to optimize from 2016 through the beginning of 2017. Test basic HRP optimization. Are you using any more Cholesky decomposition matrix? No, I'm not even sure what that is. Then we can print best params. Okay, so the first one we're going to do is optimized for 2016 through 2017. It is to simulate correlated random variables. I don't know. Is that a part of Lopez de Prado's hierarchical risk parity? Because if so, I am using it. If not, I don't think I'm using it. All right, so this one's going to be oh, I forgot to turn the optimization on. So that's this portfolio. I don't even remember what I was doing. Um, Lots of scaling though. It's scaling down a lot. Too aggressive on the scaling, I think. So this is. I want to do an optimization with only some parameters. But let's turn test basic HRP optimization. And what is this metric again? So the return score, sharp, so drawdown weighted sharp. Oh, that looks good. 1.4. One 1.43. 1.56. I may need more iterations to train it, but let's see. So let's see if it's finding different parameters. That might be something interesting. If it's getting, what's it getting? 1.56 for the drawdown weighted sharp. That's pretty good. There's a lot of parameters though, so I might need to let it go through more trials. All right, so how many trials am I using? Um, 50 trials. Okay, so let's see. Is it any better with 100 trials? And then if it's not any better, we're good. If it is better, so what did it find? Spread look back, 80 days. Spread floor. Use spread scaling true. Use AC scaling false. Drawdown penalty, 0.5. Drawdown kill threshold, 0.35. Yeah, well, I could run this. Five longs, five shorts. Holding period, 7 days. Rebalance days, 2. HRP look back, 30. Buffer multiplier, 2.5. Smooth predictions, false. Sizing method, dollar neutral. Strategy, just dot set scaling params. Target volatility, 0.14. Volatility look back, 10. Max volatility leverage, 1.25. Use DD scaling true. DD warning threshold, minus 0.15. DD penalty, DD kill threshold, minus 0.35. Oh, penalty should be 0.5. Kill threshold, minus 0.35. Use IC scaling false. IC look back. Spread look back, 80. Spread floor, 0.7. Let's test it. So supposedly that did well in 2016. 1.24 is the best value. Alright, let's run this. $1.39 best value. So let's see if we could get it up above 2. Actually, really not that bad. So it would have dropped from 100% gain in March of 2020 down to a, what is that, like 40 some percent? Down to a 43% gain in June of 21. So it did take a while to recover from COVID, but that's because the drawdown penalty turned on. By February 22, I was positive again. How are we doing on 100 trials? Best value 1.93. So 100 trials did certainly seem to improve things. So let's try 200 trials. Five positions, rebalance days 3 versus 2, holding period 5 versus 7, HRP look back 120, buffer multiplier 3, smooth predictions false, dollar neutral, target volatility 6%. So these are pretty different parameters. No drawdown scaling. There is IC and spread scaling. So let's turn the optimization back on. Now let's do 200 trials. See, do we get better parameters with that? Okay, now let's go through and put these parameters in. 5 longs, 5 shorts, holding period 5 days, rebalance days 3, HRP look back 120, smooth predictions false, sizing method dollar neutral, buffer multiplier 3. Alright, HRP look back, buffer multiplier, smooth predictions is false, sizing method dollar neutral, target volatility 0.06, volatility look back 60, max volatility leverage 1.25 again. Use drawdown scaling as false, so we can just set the warning threshold to -1. Penalty 1. Kill threshold -1. IC scaling is true now. IC look back 20 days. IC threshold 0.025. Spread scaling true. Look back 20. Floor 0.5. Good. So let's turn that back on, and then let's run it. And let's see how's this guy doing. So 200 trials now, right? Yeah, 20 of 200. And here it got to a value of 1.96, which was significantly better. Yeah, 1.57 versus 1.96. So the objective score is increasing. The more trials you use, the more risk of an overfit you have. But also the better fit you'll have, so it's a trade-off. Okay, here are the results. These actually are looking way better than I thought they would. But here all it's doing is keeping the exposure low. So volatility, information coefficient, yeah. Mainly the volatility is dominating the exposure scaling down. But it is good that these early strategies generally look good at later years. At least it's not going negative. All right, then we'll see for 200 trials. Okay, then I'm going to let this guy run. We're already up at 1.78, close to 100 iterations, so hopefully I could get much better than that 1.9 something, but we'll see. I have to go to the bathroom really quick, and I'll be right back. Sorry that took so long. I hit my head on a cabinet. Ouch. Right on the corner of a cabinet. Okay. Well, so what happened? Did we get a better value? 2.17. Again, significantly better. Ouch. Man, this stuff's all over the place, though. No, it's in beta neutral. The only constant is 5 positions. Now, 3 rebalance days, hold for rebalance every 3 days, hold for 3 days. HRP look back 30 days, very short. Buffer multiplier 3. Smooth predictions, false. That's how it was before. Buffer multiplier is way bigger, though. Sizing method's different. Target volatility is right in the middle. Oh my gosh, my head hurts. So I'm going to do some more trials because each one improves the results. So let's go back to here. Go back to here, turn that off. Turn the optimization on. And 500 was the standard we saw earlier for something else, but you know, maybe 500 will be a lot better. So lots of parameters are different. So still 5 longs and shorts. Holding period now is 3 days. Rebalance days is still 3. I forgot it was 3 before. HRP look back is much shorter. So 25% of what it was previously. Smooth predictions, false, still. Buffer multiplier actually is still 3. I didn't realize it was 3 before. Sizing method is now beta neutral. So I think that will do me better in 2020. Target volatility 0.1. Volatility look back 60 days. Max volatility leverage 2. So I need to restrict that. So I'll have to do this again and see if it improves. If I only let it go up to 1, because I can't really let it go up to 2 unless I get some leverage somehow. But anyway, use drawdown scaling is true. Drawdown warning threshold. Minus 0.25. Drawdown penalty 0.75. So pretty mild drawdown. Drawdown kill minus 0.45. Pretty mild drawdown parameters. IC scaling true. IC look back 40. IC threshold 0.005. Interesting. Spread scaling false. Whoa, that looks really good. Huge drawdown at one point, though. But overall, very good, balanced, kind of between volatility and information coefficient. Drawdown ratio, I guess, since it's because it's pretty relaxed, doesn't really ever penalize it. But so this looks like terrific. What happened during COVID? This might look the best on COVID of anything. $20.20. Peaked at %100. Dropped only down to 90% by... Oh, so it took a lot longer to recover. Because before it was turning around... around here. But I don't see, I'm kind of confused on why is gross exposure never going above 1 if the optimal parameter for the maximum volatility leverage. Hey, Soulwater. If I can have a, yeah, if my maximum volatility leverage can go up to 2, then why is the gross exposure never going above 1? Anyway, it looks so what about the turnaround? Yeah, so actually during the COVID crisis it only drops 25%, or it drops from 100% down to 75%. I don't know what percent drop that is. Um and then it turns around, but then it kind of fails again. So it ends up taking a longer time to recover. But there is, I think ideally you'd like a balance. Ideally, the gross exposure would look noisy, and then you have a good balance of things that are bringing it down. So no one thing brings it down too often. But overall, that looks pretty good. And, I solved the problem of a huge drop during COVID. I kind of pushed the drop a little bit later, but again, this is trained only on 2016. So the training stops here. And so this is after the training period. So really good. I'm watching MIT OpenCourseWare. I like MIT's stuff. They have good stuff. AI suggested me watch MIT videos. Very intense. You agree with the decision? Yeah, definitely a good decision. Watch those. They have, I mean, you can learn about everything. When I was in college, I loved watching those. Uh, AI told me to watch MIT course. I've never really seen any Yale courses. There's one sociology guy I've seen from Yale, but he seems kind of like, I don't know, I don't really like him. But, MIT and Stanford are both really good. I think that's definitely a good decision. They have and basically very interesting lectures on everything. And if you're interested in portfolio stuff, I think both MIT and Stanford. I know I've seen Stanford's, but I think MIT has one too, a series on portfolio strategy. Um, so that's pretty cool. That's pretty useful. Um, Maybe I need that right now, but I feel honestly like I'm pretty close to a good solution because, if I just sacrifice 2016, let's look from 2017 onwards. It did drop. So if we look at 2017, we had a rough time from the beginning through, really the end of 2017. It was trending down. So I guess whatever worked right in 2016 didn't work immediately. But, this is a really good sign that this looks so good, this 2016 only strategy. Oh, you mean for coding? You're watching that stuff for coding. Yeah, that gives you a good idea of the theory and stuff. It does take a lot of time. And really, how I got good at coding, I took two coding courses in my life. And one of them, do you know Chegg? That was big when I was in college, like maybe 8 years ago. I took a coding course, and all the answers were on Chegg. So it was Java. I didn't learn a thing about Java. Um, But then I also took a Python course, and I just like Python. It's naturally something that I like. Um, and so then from there, I tried to do as many research projects as I could where I was coding. And then I got basically for work, I've been coding since 2021. So now I don't code all the time, but I still have to code fairly regularly. Um, so yeah, I just tried to do something for work where I could code. And then you end up coding every day, and then I try to have some project where I'm coding. And so now I code every day basically no matter what. And then you just get used to it, and it's almost like a language you talk in. Especially with the large language machines, you don't have to be as robotic with coding anymore. You could kind of like it makes you way more exploratory. I think that's like the uh, ultimate result of AI for coding is it'll just turn you into a super coder. But AI itself probably won't code anything interesting because at the end of the day, good coding's like art. But now there's no more hurdle to be some technical whiz. Yeah, well, it is like scary and bad, but then you got to get some project that's like in your ballpark. That's like some plots of something that you think are interesting or something like that. Or um yeah, just something you're interested in. Figure out something you could code that's interesting. I would also have to investigate this drop. What the hell's going on here? It dropped. It was up 6.5x and it dropped down to 4x. That's extreme. Um, and it kept dropping. Oh yeah, that's this. So that's crazy. 35% drawdown. All right. Well, let's see what this guy's at. No, honestly, the I'm trying to do like kind of it's kind of complicated what I'm trying to do. And that's why it's been taking so long. And there's a lot of code to write. But you can actually, if you get price data, you can use the same price data I put in the description of every stream. It's really easy to get on your computer. You can have the AI help you. Um, and basically just get that, and you could do like a simple portfolio. What's it called? The Markovitz portfolio. You basically take it's the same first step that I'm doing is defining a universe, but that's just data filtering and stuff. And then once you have a universe defined, you basically what's it called? I think it's mean variance weighting. So like the mean of the returns divided by the variance of the stock. Um, and then from that you can like basically allocate money to a portfolio and update it every so often. Then from there, you can do the next step is more advanced than Markovitz. Uh, and Markovitz won the Nobel Prize for that in like 1962. This HRP diversification, this is like a more advanced method than Markovitz. So then you could code that. But the Markovitz stuff isn't complicated. And get AI to help you. Um, but when you're starting out, if you really want to learn, I think the best way to learn now is like you give this problem to AI, but then you have it explain every line of code, and you add the lines of code one by one. Like add one line, run it, see what happens. Get used to using Python uh, debugger, um, PDB. You do from PDB import set trace, and then you can put set trace anywhere in your code, and then you can go explore the variables that are in there. And so just do stuff like that and go line by line, um, and get used to, yeah, basically being good at it. So this is at 1.79. Each one, it improved the objective from 1.57 to 1.96 to 2.17. So zero point 0.4, then 0.2. I mean, it looks good when I zoom out. But that might just be because the return on later years is so high. I don't know, that doesn't look bad, does it? So what if I look at the sharp and the information coefficient? So one interesting thing here is that early times, information coefficient being low is dominating. And that's actually what worked well in 2016. But then at later times, volatility comes to dominate. That's 6 years after the training region, but it still works really well. Interesting. Anyway, portfolio stuff actually is kind of the perfect project to get into it. And if you have do you have a retirement or something, you can just, I mean, if you have a retirement, honestly, quantitative analysis, even if you're not developing a model, just if you're doing stuff like looking at charts and whatnot, um, that's like a very useful thing to be doing so that you're used to, you want to have a feel for the charts, a feel for like advanced things like this. Like if I'm looking at some sort of advanced features, what's this look like? And here the max drawdown was 337 days. So that's actually pretty interesting. It did find a good solution for COVID. So what's the value at? 1.79 still. So maybe it won't really improve. Maybe it got lucky earlier. Okay, so what's next? So I should document this. That's actually pretty optimistic. I can sacrifice 1 year to training and I get a good back test. So next maybe I'll train. So I have the results for 2016. So if I train 2016 to 2019, then I'll start out the test on COVID. That would be good. So 2016 to 2019, we have to give up those years. Hey, Moonlight, how are you? What are you up to? Anything interesting? still, we're at 246 and the best trial is 126. So probably I could be comfortable with 200 trials. I'm assuming. Sports betting, 79 bucks into 336. Holy smokes. Wow, that's crazy. How long did that take? What's the time period on that? That's a 4x. That's pretty good. That's really good. Congrats. You want to create something. What, an algorithm? Algo betting? Have you ever been on that subreddit, algo betting? It's pretty good. But the problem is there's too much legal crap with sports betting. It makes me afraid. And ultimately, you can't start a hedge fund with sports betting, as far as I know. I used to have that as an idea, but now I don't think it would be possible. From the start of May, just random. What's that mean? From the start of May, just random. I've been trying to have a good YouTube over the course of May. I want to, I want to get 5 subscribers per day is my goal. And then hopefully, we're 4 days in, but I'm on track. So hopefully my good luck continues. But what are we at? 265. We're still not above 2. What's this guy at? It's already up at 0.9, not bad. You'll share what on Discord? Your project? You have a project or something? Alright, well, I think that's going to be it for today. I just have to basically explore this portfolio stuff more. I think this is really promising, though. This looks almost like the COVID problem solved with the price of it kind of flatlines for a while. And then it actually fails at the end of 2021. So it doesn't have as quick of a turn up. And it has this really bad loss here. But, this is 10 years after it was trained. So I think there's hope on the horizon. No, the bets. Oh, your bets. Oh, yeah, share it on Discord. Hey, Sir Night Night. I'm leaving as everybody joins. But anyway, everybody, have a good day. Adios. Have a good Monday.